Dick's Sporting Goods down 24% as of right now, 111.56. Gave back all its gains. It's down 7.5% year to date. I looked at the earnings report. So they keep talking about theft. If you look up Dick's Sporting Goods earnings report, it talks about theft a lot. So in this video, I'm going to go over some of the things they mentioned in their quarterly report compared to past years. There's a lot of positives in their quarter report, but I just want everybody to understand that, 24% is a big drop for a company in one day. Big drop. Theft is an issue, but one of the things I'll tell you some stats on the theft, but in this video, we're going to go over some very beginner things, advanced things, everywhere in between. So guys, no matter where you are in the spectrum of investor, there is something in this video for you. So watch the entire thing. You will learn a lot. Stick with the channel, subscribe, you'll learn a ton. We're going to take a look at some the report, high-level metrics, some analyst estimates to see what are analysts saying about the future of Dick's. Of course, we're going to put it through our 8-pillar process, and we're going to finish it off with the important question of what price should you pay for Dick's Sporting Goods today? Because seeing this drop makes it pretty attractive, right? You sit there and go, oh, 24% drop. Is this the time to buy, right? So let's take a look at some high-level metrics. First off, $9.3 billion market cap. That's if you buy every share outstanding in the market at current market price. In the last year, it made $1 billion in net income, but only $294 million in free cash flow. That's a big discrepancy there. A lot closer when it comes to 5-year net income and 5-year free cash flow. But guys, this is retail, and they're still cash flow positive. Look at their revenue, $12.88 billion. We're going to go into their income statement here shortly and check out if that's growing or declining like all other retail. 5-year profit margin, 7.9%. 1-year profit margin, 8.4%. And the gross margin of 34%. So let's talk about gross margin. What is gross margin? Basically, every unit they sell, 34% of it goes to the bottom line before taxes. So if they sell $100 in items to you, basically $34 of it is going to go to pay for overhead and things like that in taxes. And they're left with about 8 or 8.5% after paying everything. All right. Now, dividend. They pay a dividend, 1.7%, costs them about $160 million a year. Now, I always want to compare our dividends to our 5-year average free cash flow, and what I like to look at, for me personally, is about half that metric, okay? Half that metric. We're at well under half. Does that mean it's fully safe? Well, guys, look, their last year's free cash flow was $300 million. It looks pretty safe here. Is that a guarantee? No, retail's very fickle. The consumer has been very strong lately, so if there's a pullback, that is something to watch for in these companies. So, they expected earnings of $381 per share. They reported $282. That is bad. They expected revenue of $3.24 billion, reported $3.22. So they missed on top and bottom line. Top and bottom. 3.2. So they keep blaming the theft. They wouldn't give. Now, I read it somewhere that they only do inventory once a year. And when they did the physical inventory, they realized how bad it really was. And they said they're going to make modifications to their inventory process in order to catch it a lot sooner. Because it was basically just, okay, shoot, we screwed up. We got to write this inventory down because there was a lot more theft in the warehouse. Okay, so that is a very recurring theme, though, amongst a lot of retailers. If you see anywhere in the news nowadays, there's all this talk about theft, people breaking into malls, doing all this stealing. It's real. It's out there. The net income for the 3-month ended was $244 million, compared with $318 million a year earlier. So it's still down from a year earlier, but sales rose from $3.11 billion the same quarter a year ago to $3.22. They still expected flat to 2% same-store sales growth for this year. So they kept that in line with guidance. But now they're expecting $11.30 to $12.13 per share in earnings per share for the year versus before $12.90 to $13.80. So that's some interesting stuff. Now, look at this return on invested capital, 16.7%. And guys, they have this thing called House of Sports. There are 100,000 square foot locations that are geared specifically to athlete customer base. They opened 7 new ones. This is where you can get a high return on money reinvested. Finding out how much money they can reinvest by growing their stores profitably can really drive earnings per share. But I do want to pull up the income statement here. So look at income. For a retailer, this is pretty solid. Yeah, it's been stagnant the last 3 years, but it jumped after COVID. Boom. And then all of a sudden staying up there. That's pretty impressive. Net income jumped, and it's been staying up here in the billion plus mark. All right. So at $12 a share, they have 83 million shares. That's saying it's about $1 billion again this year they expect. But guys, look at this. They've been buying back over the years. Oh boy, but look, an increase this year, in the last year. But 10 years ago, they had 118 million shares outstanding, now 83. When companies are buying back cheap shares, that is a good thing for you as an investor. What do I mean by cheap? Well, look at their PE right now, 8.6. Look at their 10-year, 5-year PE, 10.7. Look at their earnings. Let's look at enterprise value to earnings, 13. Okay, so these are good signs here. These are good signs. Now, free cash flow fell tremendously, but the 5-year earnings to free cash flow is about 19. Again, retail probably has the negative stigma attached to it, so this could be an opportunity for investors, right? Remember, we teach this. We're teaching a process here because our goal here is to make sure that you understand that when you look at a company, you don't get bogged down with the news. Bogged down with the news. You know, somebody just on Twitter wrote, why did nobody was talking about a video when it was $10 a share and now it's $4.70 and everybody's talking about it. I said, news follows the stock price, not the other way around. Again, obviously I don't know what it was worth when it was $10 a share versus now, et cetera. But the point is hype. It's very difficult to make good returns on good scenarios that everybody thinks are good. Okay, that's the issue. Let's go to our 8 pillars here. Wow, look at this. So 5-year free cash flow, we knew that was going to be an X because it was right there. And the debt here, a lot of it's probably capital leases. So I look at this going, yeah, it's 6 check marks, but I actually think it's 8 check marks, I mean. Because I'm not worried about this. That's a cash flow drop random. I assume it's going to probably rebound. And then this is a lot of debt from leases. Because they have big, you've been to a Dick's Sporting Goods. They're huge. It costs a lot of money for them to have those stores. All right. They do a good job, though, with online ordering. I order from Dick's. So let's look at analyst estimates here. All right, guys. They're expected to make $12 a share right here, going to $19 a share, according to analysts, in the next 5 years. Again, that's according to analysts. That's a 6-to-1 PE, right? Because it's currently at 111 divided by 19. 6 times 19 is 4, 5. Yeah, there you go. It's a little under 6 PE for 4 or 5 years from now. A long ways away, but this doesn't look like a dying company. Now, I'm sure along the way they're going to buy back more shares. Because let's look at the revenue growth estimates. Not great. Look at this. 2 to 4%, 2 to 4.5%, maybe 5%. It's not huge. All right, that's analyst estimates, and they're going out further, so who really knows how accurate that is? But if inflation is 3 or 4%, goods go up by 3 or 4%, labor costs go up by 3 or 4%, Dick's will have to do it. Now, hopefully Dick's is doing more and more, and one of the things I want you to research is how good are their online sales? Are they really growing their online sales the right way? We want to see growth in those online sales. Listen, we all still like going to the store, but imagine being able to just go online, order something, go to the store, pick it up, like Best Buy. I think Best Buy does a great job with that as well. All right. So, final thing. Let's take a look at the stock analyzer tool. Guys, this is the tool that has been used over 2 million times on our software since we started keeping track. It allows us to make assumptions about the future and then tell us what price to pay for that. And this software, EverythingMoney.com, running a special 20% off. Check it out. There's a lot of tools here. There's our community chat. So it's not just what you've seen already, but it's all on your phone as well. It's an app that has everything from the web on the phone, 10,000 companies on your phone. This will really help make life easier for you as an investor. So revenue growth. I'm going to go 2, 3.5, and 5%. Let's say they really kill it on online sales. Let's say this new House of Sports does even better. They keep growing, inflation's in. Let's go 5% on the high side. That's a lot, but let's put that. Actually, you know what? Yeah, I'm fine with that. I'm actually going to go 2, 3, and 5. I usually like to split it, but I think I'm going to go 2, 3, and 5. Now, profit margin. It's been increasing. Look at this. 10-year profit margin, 6.4, 7, 9, 8, 4. Okay. So I think I'm going to do 6, 7.5, and 9. Free cash flow margin. Now, free cash flow is actually lower than their profit margin, which is kind of surprising. So I'm going to go 5, 6.75, and 8.5. That 8.5 is going to be hard. Now, PE. Guys, when it comes to PE and price of free cash flow, the one thing I recommend is start at 15. That should be your baseline. Okay, 15 is my start because the market average should be 15. I go higher with a high return on invested capital, a large moat, a large growth rate. The only thing they really have here is a high return on invested capital, which is still great, but the moat isn't there. I don't think there's a moat around DICKS, and the growth rate isn't there. So you got to remember that. Now, they can grow their earnings, as we saw according to analysts, that they could potentially increase their earnings by 50% in the next 4 or 5 years. But I would be apprehensive with the PE, especially considering it's still retail. So I'm going to go with 10, 13, and 16 for both of these metrics. Now, for my desired annual return, the key here, guys, is as you make higher and higher assumptions, you need a higher desired return because they're less likely to occur. So that's your margin of safety. But we've already also hedged a little bit here and gone aggressive here. So do you do as high a desired return here? It all depends on, first off, how bad you want that. Like I was just talking about PayPal with Dalton, our researcher, and he put in 13% on the low side. I go, Dalton, what the heck? He goes, Paul, I don't want PayPal unless it's a screaming deal. I said, fair enough. Fair enough. That was for him. He's like, listen, I just want to buy, $50 billion plus company. I'm like, well, PayPal's there. But either way, he said he wanted really large companies that are no-brainer prices. And I think PayPal qualifies, but he doesn't want it. Great, more power to him. So if you don't want retail, put a high number in there. Put higher numbers down the line here. That's great. So for me, I'm going to do 12 because I already beat it up and I don't mind owning retail, 14 and 16%. I'm going to hit the analyze button. Guys, I just want 1 or 2 more minutes of your time. That's it. Listen to the rest of this video. And again, if you like the software, if you like what it can do for you, EverythingMoney.com, 20% off is our current special. Analyze button, boom. A low price of 70 to 80, a high price of 140 to 150, a mid price of 100 to 111. We're at that right now. So I'm actually going to add it to my watch list to be notified when it hits $90, if it hits $90 a share. Because I'm okay not getting it, but if it gets stupid cheap, I'll take it. So I'll put a flyer on it. Guys, thank you very much for your time. One thing I want to add in here, if you pay the current price and the low assumptions occur, you're going to make about 4.76%. That includes dividends. The middle assumptions occur 12.2. High assumptions occur 20%. Thank you for your time.